What if I told you retirees can safely withdraw 6% of their portfolio each year? You might call me crazy, reckless even. After all, the traditional wisdom says it's been closer to 3 or 4% in the past. But DIY investor Blake Hilgemann has built a portfolio that he says makes it possible. And he's got the data to back him up. So let's find out how he's done it. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. We've got a fascinating and perhaps even controversial conversation lined up for you today, one that might have you throwing the 4% rule out the window. We're going to find out what's inside a portfolio that has historically supported a 6% safe withdrawal rate. And later, we'll be taking your questions on all things retirement, so stick around to the end. For now, let's get into it. Joining us is Blake Hilgemann, founder of Pathway to FI, a community for investors pursuing the FIRE movement, or financial independence, retire early. Blake, wonderful to have you with us. Really appreciate you taking the time.
Yeah, great to be here. Thanks, Rob.
Yeah, absolutely. I got to say, your paper was absolutely fascinating. I really enjoyed digging into the numbers here, and we're going to get into all that number crunching in a moment here. But I got to say, with all the market volatility that we're subjected to these days, I'm kind of curious on a personal note here. Are you at all second guessing your decision to kind of kickstart your early retirement a little bit, shifting to part-time work rather than full-time work about a year ago? How are you feeling these days?
I'm feeling great. Obviously, it is an interesting time. We've typically had times like these with fear and volatility in the markets every decade, every 5 years even, that we're going to experience this. I think that, I've had a lot of planning, a lot of preparation going into this current stage of life that I'm in. And if you're waiting for the markets to be perfect, you'll never make a move. So as you mentioned, I did recently move part-time, and I'm really excited to be in this life stage where I have more time with family, more time to be in the great outdoors. I live in the mountains in Colorado, and just really love all the outdoor sports and activities associated with that. So yeah, I started my career in 2007. Now, that was the beginning of the Great Recession, as most of you know, and so it was obviously an interesting time to get started in my investing career. The markets dropped 50%, and that's actually an advantage for someone who's just starting to accumulate assets. But as we're talking about here today, when you're starting retirement around that time frame, it can be very scary. So I've studied the markets ever since from that time frame forward, and I've learned that there's always going to be fear in the markets. We're always going to be, in the middle of a downturn or just before a big gain, but you don't know the future and what it's going to hold. So, this time is no different. And I think that the portfolio I've built and the research that I've done will help me to weather any scenario.
It's good to hear that you're still confident in the face of all this volatility here. You're right. I mean, the market is never perfect. It always keeps us on our toes here. But nice to hear that you're still resting easy so far these days. But that said, there are some retirees out there that are really struggling right now, trying to figure out what are they supposed to do with their portfolio. And I'm just curious, you had this plan going into it, your means tested it and stuff like that. But are you changing anything about your approach or your retirement strategy to kind of help minimize risk while we're seeing all this market volatility?
No, I mean, I don't change my plans based on any current events. I think the plan should be based on your current life stage, not based on fear that's being projected in the media, not based on your age even, just really where you are financially. Are you in an accumulation stage? Are you in a wealth preservation mode? Or are you in retirement, which is an extension of wealth preservation, but now you're at a place where you're spending down your assets rather than accumulating.
Yeah, so I mean, all these retirees out there that might be struggling right now, listen, TD Direct Investing, we got you covered. We got all kinds of educational content here for you that can help you navigate specifically the market volatility we're seeing, as well as just level up your knowledge in general here. So check all that stuff out on our socials and the Learning Center on Webroker. That said, if you do feel like you need a little bit of help dealing with all of this uncertainty here, you can scan the QR code on the screen here, and you'll reach out to a financial advisor here who can help maybe hold your hand through some of these things and help tailor some advice specifically to you to help you through all this. Anyway, with that said, Blake, I want to get into the heart of our conversation here, and that is, of course, this portfolio strategy that you feel can support a 6% safe withdrawal rate over a 30-year retirement. And for those in our audience who want to get in on the conversation, we'd love to have you. Make sure you submit your questions to us. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, click on the link in the description. It's going to take you over to our broadcast platform, and that's where you can ask your question there. All right, Blake, I think first off, let's just do some table setting here. You know, we've heard about the 4% rule. I teased it in the intro there. It's a popular safe withdrawal strategy for many retirees. I have seen some research, though, that suggests that something around 3% is actually a little bit more sustainable here as conditions change over time. So what gives you the confidence that your approach can basically double that rate?
Yeah, well, you know, that research and the mainstream media, right, uses two asset classes to create portfolios. And so that's inherently limiting in how diversified you can be. Those two asset classes are large company stocks like the S&P 500 and U.S. Treasury bonds typically. So we have much more data now. We have many more asset classes to choose from, and we've been collecting data on those asset classes now for a long enough period of time to encompass a great number of market cycles, different types of investment scenarios that retirees might experience, and some really challenging ones. The research that I did looked at about 10 asset classes, and I started constructing portfolios using 7 of those that I thought were very valuable in really helping us weather these types of downturns that you might have experienced if you retired in the 1970s, for instance, a time of very high inflation, where both bonds and stocks fell considerably, or in the 2000s era, where we had the dot-com bubble and then the Great Recession, as I mentioned earlier. I think that's where you need to really incorporate more than just stocks and bonds. But there are other assets out there like gold. There are other classes of stocks that can help you diversify within the equities classes, like small cap value, which is really on the other end of the spectrum from large cap growth that the S&P 500 is concentrated in. So now even Bill Bengen, who coined the 4% rule, he agrees that you can do better today if you incorporate more than just those two asset classes that he originally had data for back in the 1990s.
So, I mean, diversification being the only free lunch, we've heard that before. So it seems like you're really leaning into that phrase there with your model portfolio here. We're going to dig into, obviously, what it's composed of here. One of the things I really appreciate, Blake, is that you're a true outdoorsman, right? You create these model portfolios for each of the major steps along the investing journey, and you've likened them to phases of climbing a mountain. I can barely climb a hill personally, but I love the visual here. I want you to take us through this descent portfolio, which is the retirement portfolio. This is the one that you feel can support a 6% safe withdrawal rate. What's inside this thing?
Sure. So I believe that every portfolio at its core should have the large cap blend or growth category that the S&P 500 represents. And so it does have that at the core. All of the portfolios that I've looked at, for whether you're accumulating, whether you're financially independent, maybe not ready to retire yet, or whether you are starting to draw down from your assets, I think that is the base and a great place to start. I also look at small cap value, I mentioned before, which is really on the other end of the spectrum from a large asset class perspective. And so it performs the most differently at different times than large cap growth stocks do. And then I looked at international as well, because that's about 40% of the world economy is based in countries other than the United States, where I am, and where much of this research again comes from whether it's the 4% rule or others that come up with other numbers that are a safe withdrawal rate according to their data set. I believe that international, although it is more correlated with the U.S. stock market, because these are large companies generally that dominate these cap-weighted indexes. I believe that it does help to diversify both in currency and in geopolitical aspects. And again, we can see a lot of that going on today with all the tariff talk, where the United States is actually attempting to devalue the currency in order to improve its trade, and that's affecting equities. And the U.S. stock market is going in one direction while the rest of the market is doing a little bit better. But then I've gone outside of that, and I've kind of dug more deeply into different industries within the stock market that are maybe underrepresented because they are smaller as a proportion of the overall economy, but that I thought were very interesting for a couple of reasons. The first one is real estate. And so generally in the publicly traded markets, we're invested in REITs, real estate investment trusts. And those are, again, they're more uncorrelated with the large cap stock market than many other types of industries. And they perform differently at different times again. So another thing about them is that they produce a larger income stream, which can be helpful at times when the markets are down and you need to draw on income, but you don't really necessarily want to sell shares when it's down that low. So I think that really helps from an emotional perspective. So I wasn't done there. I like the idea of real estate, but again, during a time like the Great Recession, it was real estate driven. And so that wasn't a particular asset class that helped out in a scenario like that. So I found another one, and that's in utilities, which I find very intriguing. Utilities are great because they're what I would consider more recession-proof for publicly traded companies, because in times of recession, when people are losing their jobs or when they're afraid to go out and spend money, they're still going to keep the lights on. They're going to keep running heat, and they basically, utilities are essential needs for living. And so they tend to do better in times of recession when many other areas of the economy are struggling.
So that's sort of the utilities real estate angle. I think that's really interesting here, Blake. One thing, and I totally appreciate the diversification angle to this and the lack of correlation to your traditional stocks and stuff like that. Looking at this portfolio, though, one thing that jumped out to me is that we've still got 70% in stocks, right? And that might sound high to some retirees. Like, why are you comfortable maintaining such a high exposure to equities of any kind?
Yeah, well, as I just walked through, there are 5 different categories of stocks here. And so one thing that helps me to be comfortable about this is that it is so highly diversified within the stock category. And these are different types of assets that do different things at different times. And that's what you really need, especially in those worst parts of the market, when large cap value tech companies are really struggling. Real estate and utilities might be doing just fine. And that's what we saw in 2022 most recently, when almost every category of stocks were down, utilities were flat. And that's the kind of characteristic you really like to see. But the other 2 categories that I have in my portfolios are long-term bonds and gold. So that's where the other 30% comes from. And the reason that I go to long-term bonds, these are bonds that might have durations of 25 or 30 years, is that by having such a long duration, they're very sensitive to interest rate changes. And so it's kind of like an amplification getting some leverage on those bonds. And by having that response amplified in a portfolio, you really don't have to hold as much of them. And so that leaves more room for stocks in a portfolio. The other thing is that I wasn't comfortable with just holding bonds as my alternative asset, let's call it. But I also looked at gold, and although gold is really a terrible investment on its own, it does some really interesting things when you look at those most challenging times in the stock market. Gold has done some great things to help bolster portfolios and keep them from such a large downside loss. And you can see that even going on today with gold, where it's outperformed the S&P 500 over the last 2, maybe even 5 years, based on the devaluation of the currency and the fact that gold is denominated in U.S. dollars. That's helped a lot. And it's also a place that people go to in times of fear. And so gold is really interesting to me in that it just really kind of stands out as on its own. And in times of high inflation, like the 1970s, like in 2022, where we saw stocks and bonds go down together, that's when something like gold has really flourished and held its value or increased in value substantially.
Fascinating stuff. I appreciate you giving us a deep dive inside the portfolio and the rationale behind it there, Blake. We got a lot more to get to, but before we continue, I just have a quick question for our viewers. Are you enjoying the show so far? Have we piqued your curiosity? Well, then make sure to follow TD Direct Investing on social media. We're on YouTube, we're on Instagram, we're on Facebook, so you can scan the QR codes there. You can check out sneak peeks at upcoming episodes, as well as a ton of other content designed to help build your investing knowledge. All right, Blake, let's keep our noses to the grindstone here and get back into it here. I think the real question a lot of people might be asking is, okay, well, how does this Descent portfolio of yours stack up against other sort of traditional model portfolios that we've seen? And you've done a lot of really interesting research around this. Maybe you could speak to that.
Sure. Yeah, and I think there's a chart on that would be really interesting to go through a little bit. So I selected a number of metrics and some portfolios to use as a baseline for comparison. And if we're focusing on the Descent portfolio, which you see at the bottom of this table here, the two portfolios that I chose for baseline comparison are a 60-40 stock bond split and a golden butterfly portfolio. You can see that those two portfolios, the 60-40 and the golden butterfly, are fairly different from each other. And when you look at their makeup, it stands out why that might be. The golden butterfly is really interesting. It's less mainstream, but it would be considered a risk parity portfolio, which means it's really balancing the risk by diversifying very highly across a number of asset classes. And what it is it's a 20% mix or split across large cap growth, small cap value, long-term and short-term bonds, 20% each, and gold. So it's more heavily concentrated in bonds and in gold than what the Descent portfolio is. And when you look at this comparison here, that means that it does have a lower standard deviation, lower volatility. It does have a lower deepest drawdown. You can see it's only lost 10% at most since 1970 from any starting point looking forward. And it has a very short recovery time of 3 years. So it's a very stable portfolio and not a bad one at all for a retiree to look into. But where I wasn't comfortable with the golden butterfly is that it only has a 40% stock allocation, and so I was really looking for something that can have a better upside as well. So with the Descent portfolio, as you saw there, the average annual returns are much higher. While it does have the potential to lose more money in some of these more challenging times in the market, the Descent portfolio also has the ability to recover quickly as it's done in those timeframes. And as you may have seen on the right side of that chart, the safe withdrawal rates turn out to be higher because of these greater overall annual returns. So it will bounce back. It may take a little longer to bounce back than the golden butterfly, but it's doing much better than the traditional 60-40 portfolio that most retirees are looking at these days. And it bounces back with with a larger average annual return in most cases, and therefore it's able to sustain a very, very healthy safe withdrawal rate. Looking at the 60-40 portfolio safe withdrawal rate, it's 4.4%, very close to that 4% rule. But as you can see historically with those other two portfolios, by having that greater diversification, it's really improved things by a substantial amount. Where we're looking at over 6%, we're talking about an income potential of 50% greater than most retirees might be planning with the same dollar value.
Yeah, certainly. I mean, who wouldn't say more to 50% more income, right? That sounds pretty good to me. One of the things I found really fascinating about the comparison there is that the Descent portfolio, it's like a very close second in a lot of key metrics, and because it's so consistently like second place, it ends up being first place when it comes to the safe withdrawal rate, which I found really interesting. I could see people looking at this thing saying, hey, look, I'm intrigued here, but I don't want to spend my golden years sitting in front of a computer screen and tweaking my portfolio to make all these more complex portfolios work. How could they build something like the Descent portfolio in a relatively simple, straightforward, easy fashion?
Yeah, and that's the great thing. And I think what really enables these types of portfolios these days, where back in the 1990s, it wasn't quite possible. We have so many ETFs out there now that cover any type of asset class that you could imagine. So gold is very easy to hold now. Rather than having to physically hold it and put it in a safe, you can own an ETF that's traded in the same way as any individual stock, and it's very, very simple to buy gold now. That's held by an independent company, usually in a safe down in London somewhere, and at a very low cost, you can hold on to this. And when it's time to sell a small amount of gold to fund your lifestyle, you can do that in the same way as if you were to redeem a share of a stock or a bond. This wasn't so easy to do back then. Bonds as well. There are ETFs at very low costs that are just as easy to hold as a stock, where you don't have to buy individual bonds and spend all of your time on Treasury Direct, let's say, or wait for a long-term bond to mature 25 years later. These things have all been made so much easier by ETFs and by the competition that they've created for low fees.
Yeah, it's fantastic how spoiled for choice investors are these days with all these ETFs and different products out there. And I appreciate the fact that you've used that to find a more interesting, compelling way to consider building a retirement portfolio here. I think one of the key questions for retirees, though, is looking back on past bear markets, how has the Descent portfolio performed during some of those nasty periods?
Yeah, and I think the most concise way to explain it, to show its performance, is to look at its safe withdrawal rate. So the safe withdrawal rate means that, or a higher safe withdrawal rate, I should say, means smaller losses, means faster recoveries, and it means that it supports more income without running out of money in the worst times that the economy has seen for investing. So if you go back to that metrics chart, you can see that the worst drawdown for the Descent portfolio was 24%. So you'd have to think about, am I willing to have the possibility of being down 25% roughly a quarter of my portfolio at some point during my retirement. And am I going to be able to grid it out and continue drawing the same amount of income that I plan to need during those years to allow it to recover? And it can take as long as in this 52-year time frame that I've studied, 5 years for it to recover. So you can see that 24% drawdown, it looks much more palatable than if you imagine a 60-40 portfolio holder drawing 4.4% and still seeing a 37% decline in their assets and a 12% time before they get back to the portfolio level that they started with. And that can be very scary. And I should mention that all of these numbers are inflation adjusted. So if you're thinking, well, inflation means that you're going to be losing value over time as well, that's all calculated into each one of those metrics. So that's a very, I think, compelling to me to see that in some of these times, like the 1970s, where inflation was much higher than what we've seen in the 2020s era, that these portfolios held up with a very high stress test. If you're talking about drawing more than 6% each year.
That's a really good reference point, because I know inflation's been top of mind for many folks, coming out of the COVID pandemic and stuff like that. Very top of mind. So to know that at least there's, a history doesn't repeat necessarily, but it rhymes. There's something that we can look back to there, I think could give people some good degree of confidence here. Really quickly, Blake, I just have a question for you. I know you don't have a crystal ball here necessarily, but I have seen some researchers point out that U.S. stock returns in the past have been downright exceptional, to the point where they've almost been like a statistical anomaly. That's how good they've been over the past several decades. And the theory is that it's kind of unlikely that they're going to repeat such phenomenal performance here. How do you think that would impact the safe withdrawal rate here of the Descent portfolio? Like, could you just sub in, some kind of international stocks and it would be pretty much the same thing? Or would that really meaningfully change that safe withdrawal rate if U.S. stocks weren't quite as exceptional as they have been in the past?
Well, first, I think I have to disagree a little bit that this is an unprecedented period for stocks, where we've really seen about 15 years of good returns since the bottom of the Great Recession. And that was on the tail end of what many have called the lost decade, where in the 2000s, we had the dot-com bubble burst, where stocks declined generally by about 50%. Then as they recovered in the middle of the 2000s, they fell again in the Great Recession, when we saw a financial crisis and a real estate crisis. And so partially why we've had such a great run for stocks is because they were such great value coming out of the dot-com and the Great Recession era. We saw that again in the 1980s and 90s. We had a couple of great decades for stock market returns, but those were on the heels of this inflationary period of the 1970s that was possibly one of the worst times for retirees to begin withdrawing from their portfolios. We saw stocks and bonds, as I mentioned, fall at the same time. And so people in these traditional portfolios really had nowhere to turn. So in both of those scenarios, looking back over the last 50 years, we had some great decades, but they were following some very challenging decades. And there's no telling what we're going to have for this next decade. But these things can run the course for a very long time, for much longer than someone who is determined that we're going to see worse stock market performance can hold on to those convictions. If we do have a bad decade to come, once again, it is going to eventually show that these companies have much better value, that they've been oversold, and those markets can recover very quickly. That's when I would expect, again, another great run in the stock market to come at some point. once again, that turnaround can happen much farther out in the future than any of us can expect. So I would never try to predict when these things would happen. But once again, I think that that over time, we're going to see average stock market returns. They just never come as an average 8% per year. It tends to look like minus 20 and then plus 30.
Yeah, and those gyrations are something that you just have to kind of deal with as an investor here. But anyway, really appreciate you sharing your perspective and giving us a deep dive inside that Descent portfolio, Blake. It's really fascinating stuff. I encourage people to dig into the numbers themselves if they're curious about this. I want to move on to another segment we have here, though, Blake. We like to call it Hot Takes, okay? And we've heard a lot of interesting perspectives about investing both in the media and on our program in the past. So I want to bounce some ideas off you, see if you agree or disagree and why. And this first idea comes from financial influencer Dave Ramsey, who I know you're a big fan of. And speaking of 8%, he says an 8% safe withdrawal rate is possible for retirees holding an all-equity portfolio. His rationale goes like this. The S&P 500 index has averaged 11.8% per year since it began. So let's say you make 11%. If you left 3% in there so that it would grow a little bit and cover some of the inflation, you pull out 8% a year, you'd be living off of roughly $90,000 per year with a $1.4 million portfolio. The account is growing by 3% a year if it averages an 11% rate of return, so it never runs out. It's going to continue in perpetuity. You're not going to run out of money, basically. So, Blake, I'm curious, as a big fan of Dave Ramsey, 8% safe withdrawal rate here, is this genius or is this absurd?
Yeah, I mean, first off, I want to say that, I think Dave has done more than anyone else in history to get people out of debt. And so I really respect him for the work that he's done. But I want to say that the math doesn't work the way that it was laid out there. And I guess I led into that really well, that you don't get 8% every year. You don't get the average. What we get might look something like you lose 15%, then you gain 25, then you gain another 10, then you lose another 20. And so we never know what any 1 year is going to hold. And if you're down 50%, like we saw, like I said, in the 2000s era, we saw this twice. If you're down 50% from your starting point and you have to draw 8%, you now have 42% of your starting portfolio. And even if the market fully recovered the following year, which it likely takes a little longer than that to do, you'd be left with 84% of what you started with. Then once you draw your 8%, you're down to 76%. And another big drop, a 50% decline from there would essentially wipe you out. If you're going to continue to draw that 8% every year. And that's why the safe withdrawal rate math doesn't take into account averages, but it has to look at these kind of worst times to retire and what happens when you're drawing assets from a down portfolio. You have to draw more shares of those stocks, more taxing on those bonds to pull an income out of them during these down periods, and it's very difficult to recover if you're drawing too much at that point. No one in their right mind is going to continue drawing 8% once they're down to 42% of their original balance. You're going to have to make adjustments, and that's why you can't just rely on those averages to determine how much you can draw from a portfolio over time.
Right, so the sequence of returns here, really crucial to keep in mind here. Sorry, Dave Ramsey, it doesn't work the way that you kind of outlined it there, but anyway, thanks for the perspective on that one, Blake. We have one more idea for you here. This one's from Ben Felix from PWL Capital, and he says bonds and cash equivalent products can actually be a hidden risk to a retiree's portfolio due to the lower returns they tend to offer.
The big risk for a long-term investor is that their investments don't end up earning enough of a real return, a return adjusted for inflation, to meet their future spending goals. Retirees are not spending their whole portfolio tomorrow. They're spending 3%, maybe 4% per year of their portfolio. So even if things do decline, if you're not spending very much from your portfolio, I would still say that you have a long time horizon. A longer term investor who can withstand volatility can invest in riskier assets like stocks.
So Blake, what do you think about this idea that bonds aren't all they're cracked up to be for retirees?
Well, I have to agree. In some respects, you do need the returns and inflation protection from stocks in order to survive a 30-year plus retirement. But I'm not sure whether he's recommending an all stock portfolio in that case, because going all the way to that end of the spectrum, it also is hurt the most by the sequence of returns risk of a retiring at a very bad time in the markets, just on the precipice of a large decline. So again, that's when no one in their right mind is going to keep the same course as if you have this all stock portfolio, knowing that that large return is on the way, to keep drawing money when out of that portfolio at the same rate when it's down 50% or more. Is very challenging. And that's why you need that diversification. You need some assets that aren't going to decline as far at those times so that you can pull your income from those and allow your stocks to recover.
Right, bonds giving a little bit of a smoother ride in a portfolio that can help with the psychological aspect of retiring and drawing from your portfolio. It can be a hard adjustment for people to make sometimes, and especially with market volatility like we're seeing. So bonds do play a role. Thank you so much, Blake, for sharing your perspective on those hot takes. I appreciate you playing along. Another thing that we've been talking about, obviously, and it's core to any retirement plan, is obviously knowing how much income you're going to need and how much of your portfolio can actually generate from it. So on that note, I want to throw it over to my colleague, Caitlin Cormier. She's going to show us a nifty little income projection tool in WebBroker.
Under the accounts menu, under accounts details, we're going to choose projected income. And that is how you will access this tool. What it's going to do is it's going to show you a projection of all distributions that should be paid in your account, assuming nothing changes. Of course, this is a projection, so if you buy more securities or sell securities, it's not going to take that into account. However, as of your current state of your account, it's going to predict what dividend and interest payments you can expect in your account. So if we look, you can see each month is broken down. You can see how much is going to be paid in each month. You'll notice there is both a purple and blue line through the middle here. The blue line is to set a monthly target. So if there's a specific amount of dividends that you would like to receive each month, you can go ahead and set that amount and it will show you how close to that you are. It's also going to show you your full 12-month projection, total amount of dividends and interest, and your monthly average. At the top, you can see you are able to choose which accounts you'd like to see this information for. So you could select, for example, registered plans, non-registered plans, or whatever combination you would like to see this information either more holistically or on an individual account basis. There is more specific information about those individual securities and the dividends they will pay. So it's going to show you how many securities you have of each, what the total amount in the next 12 months projected is, and then of course when those payments will be for those individual securities.
All right, thank you so much for that, Caitlin. And Blake, again, appreciate you joining us for all of this conversation here. We're going to have to leave the interview portion of our conversation there, but we're not done yet, okay? We're going to take some questions from our audience here. Are you ready to know what they want to know more about?
Let's hear it.
All right. Our first one here comes from Chris, and Chris is wondering, does the safe withdrawal rate, whether it's 4% or 6%, apply specifically to a 30-year plan? What if somebody wants to retire at 55 and expects a longer retirement?
Yeah, that's a great question. So, and it's very pertinent to my own planning. I am planning for a retirement that's longer than 30 years. And there's a concept that I actually have calculated out through the tools that I use that's called perpetual withdrawal rate. And the perpetual withdrawal rate is rather than, I'll contrast that with the safe withdrawal rate, is in a 30-year time horizon, the portfolio does not run out of money. A perpetual withdrawal rate means that in a 40-year time horizon, a portfolio has maintained its original balance. And at that point, if you keep projecting further into time, the way the math works out from there, you will not run out of run out of money for as long as you live. And so I like to look at the perpetual withdrawal rate. And it turns out that the perpetual withdrawal rate ends up being about 1% lower than a safe withdrawal rate. So for a 30-year time horizon, if a safe withdrawal rate has been 6%, then a perpetual withdrawal rate might be around 5%. So in that circumstance, I think that's why you really have to be careful about what you're looking at, what it means, and what your own individual circumstances and planning are to take into account that longer time horizon. But yeah, the math is there, and there are ways to project for that as well.
All right, really interesting stuff here. We got another question coming in from Wassel. They want to know, how often do you rebalance your portfolio? Good question.
Well, I look at either a 6-month or a 12-month time frame, and I try not to time the markets in when I do that rebalancing. I think that the research has shown that a 6-month or a 12-month, they work out just about the same in terms of when you rebalance. So it's really a matter of how active do you want to be in managing your own portfolio, and I think my plan will be to try to stick with that 12-month rebalancing interval, and that's a good time as well to go in and take profits and kind of pull aside 12 months of expenses as well to cover the upcoming year of your life.
Yeah, 6 months, 12 months, these are all pretty typical time frames here. One of the great expressions I've heard is that your portfolio is like a bar of soap. The more you touch it, the smaller it's going to get, right? So maybe doing more infrequent check-ins like that, 6, 12 months, maybe it makes some sense. In any case, we have another one coming in here from Tazim and others. There's a group question here. They're saying, I will be retiring in 6 months, currently have 60-40 portfolio. What do I need to consider if I'm thinking of switching to the Descent portfolio, like the actual mechanics of making that switch? What would they need to think about?
Well, yeah, first it's a matter of identifying a good set of low-cost ETFs or mutual funds that cover those asset classes. Really understand what the fees associated with those are and the mechanisms. Looking at if you're going to transition from one portfolio to another, you need to understand if you have commissions involved or kind of a back-end load, they might call it, are you going to be paying those fees by selling and being prepared for that? But also to look at the taxes for selling. If your portfolio is in a taxable account, really understand the tax considerations involved there. You may want to split it up over a longer period of time, a number of or a couple of different years to smooth that out. So other than picking the right indexes, the right funds to transition to, looking at the tax implications and the fees of those, I think it's just a matter of really understanding how that portfolio that you're switching to has performed historically and doing some thought experiments and being prepared for some of those downturns. And are you prepared to see those potential losses in your portfolio, and how will you behave when or if that occurs?
Right, yeah. What's the expression? Those that fail to plan to fail, right? You want to be crunching the numbers. You want to be thinking through these scenarios before you make any big changes to your portfolio. But thanks for the practical tips on how they can kind of think about doing that, Blake. Listen, that's all the time that we have for today, though. Really appreciate you joining us in this conversation. Really fascinating stuff. Again, I encourage folks to check out the numbers for themselves if they're curious about this Descent portfolio and other sort of model portfolios. Little bit outside the box here that you might have heard of before. Anyway, Blake, thanks again for joining us. Really appreciate it. And thank you to our audience for tuning in as well. Make sure you check out next week's episode here, Thursday, 2 p.m. Eastern, as always. We're talking stock picking with DIY investor Daniel Pronk. He's going to tell us what he's looking for to help spot good stock opportunities in these volatile markets. Really interesting conversation coming up here for you. For now, though, that's all the time we have. From everyone at Inside Investing, thanks again for watching, and we'll see you all next time.